All right, let's get right into it. We're going to talk about one of the most popular and, one of the most controversial metrics in all of finance, EBITDA. To some people, it's the absolute best way to see a company's real core health. But to others, it's just a tool to paint a deceptively pretty picture. So, what's the real story? Is it a brilliant tool or is it a dangerous trap? At the end of the day, this is the one question every single investor, every analyst is trying to answer. Is this company actually making money? But as we're about to see, the official answer, well, it isn't always the full story. You really got to know what's going on under the hood. So, the official starting point for everything is always net income. It's calculated according to what's called generally accepted accounting principles, or GAAP. It's the bottom line for a reason, right? But what happens when you try to compare two different companies? Imagine one has a massive tax bill just because of where its headquarters is, and another has huge interest costs because of how it decided to finance its growth. All of a sudden, their bottom lines aren't really telling you the same thing about how their actual operations are performing. And that's exactly where EBITDA enters the picture. The whole point was to strip away all those messy, complicating factors to get a much cleaner, more comparable look at how a business is actually doing. So what is it? EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. Now, the key thing here is that it's a non-GAAP metric. That means it's not part of the official accounting rulebook. Its entire purpose is to show you how much cash a business is cranking out just from its day-to-day operations. And calculating it is actually pretty simple. You just start with that official net income number, and then you add back the stuff that was taken out before. You add back the interest, you add back the taxes, and you add back depreciation and amortization. Okay, so why do we add these specific things back? What's the logic? Well, interest, that's really about a company's financing choices, not its core operations. Taxes, they can be all over the place depending on where a company is located. And depreciation and amortization, and this is a big one, they're what we call non-cash expenses. They're accounting for past investments, not cash leaving the bank today. The whole goal, the entire point, is to take out these variables so you can get a true apples-to-apples comparison. But, and this is a big but, this is where things start to get a little tricky. We're moving beyond simple EBITDA to something called Adjusted EBITDA. And this is where we go from doing simple math to what sometimes feels more like an art form. So with Adjusted EBITDA, the idea is to show what a company's normal year of earnings might look like. To do that, companies start removing even more expenses that they label as one-time or non-recurring. Now, in theory, this is supposed to give you a clearer picture. But who gets to decide what's unusual? That's where the line between providing clarity and, frankly, being deceptive starts to get really blurry. And this is the absolute key. You have to know the difference between a reasonable adjustment and a really aggressive one. Look, adding back a one-time cost for moving your entire headquarters, okay, that seems pretty valid. But adding back your normal recurring sales and marketing budget by calling it a growth investment, that gets super questionable. The line between showing a clearer picture and just making up a better-looking number can get very, very thin. And this brings us to the dark side of EBITDA. We need to look at how this metric, which honestly started as a pretty useful tool for clarity, has been twisted and used to completely obscure reality. To really get how we got here, you gotta look at the history. EBITDA was basically invented back in the 70s by the cable TV pioneer John Malone. He needed a way to convince lenders that his high-debt business could work. Then, in the 80s, it became the go-to metric for leveraged buyouts. But things started to get a bad rap during the dot-com bubble, when a ton of unprofitable tech companies used it to look like they were profitable. And then in 2018, WeWork took things to a whole new galaxy. And, probably the most famous takedown of EBITDA comes from Warren Buffett himself. See, by ignoring depreciation, which is the real cost of your assets wearing out, EBITDA basically pretends that maintaining your business is free. As Buffett famously put it, it's like management thinks the tooth fairy pays for capital expenditures. It's a huge, fundamental flaw that you just can't ignore. Which brings us to the poster child for this whole mess, WeWork. They didn't just use Adjusted EBITDA, they literally invented their own metric and called it Community Adjusted EBITDA. And what did they adjust out? Oh, just the basic core costs of actually running a business. Things like general and administrative expenses and their entire sales and marketing budget. Their argument was that these were growth investments and shouldn't count against their profit right now. And just look at this. This one slide says it all. By adding back those core business costs, WeWork magically turned a real EBITDA loss of almost $200 million into a community-adjusted profit of $233 million. It's not just creative accounting, it was pure financial alchemy. It was a complete fiction that for a little while managed to hide the massive structural problems in their business model. And the WeWork story isn't just some crazy anecdote. The market impacts of this stuff can be severe and last for a long time. In fact, academic research has found a direct link between this kind of aggressive, income-inflating non-GAAP reporting and a much higher risk of a major stock price crash down the road. It just goes to show that when you hide bad news for too long, the correction, when it finally comes, can be sudden and incredibly painful. So, with all that in mind, how do you protect yourself? Whether you're an analyst or an investor, how do you actually spot the red flags? How do you tell the difference between the useful tool and the dangerous trap? Let's walk through an actionable checklist of things to watch for. Luckily, the SEC has given us some pretty solid guidance here, and it creates a great list of red flags. You should be really wary if a company starts disclosing normal, everyday cash expenses. Be super skeptical if they call something non-recurring when, it seems to happen every couple of years. Also, watch out if they're quick to adjust for one-time losses, but somehow forget to mention any one-time gains. And here's a huge one. If a company all of a sudden starts shouting about EBITDA when they never used to talk about it, that often means there's trouble brewing in their real GAAP numbers, and they're trying to distract you. So, I'll leave you with this question. The next time you see a company report adjusted earnings, don't just take that number at face value. Ask yourself, what exactly did they adjust for? Are those adjustments actually reasonable? And most importantly, what story are the official, boring old GAAP numbers telling me? The answers to those questions, well, they can make all the difference in the world. This is not financial advice.